All right, so you're listening because you're looking for ways to make your money work harder for you, especially with so much uncertainty in the market. And I get it. Who isn't?
Yeah.
That's why we're diving into the world of high-yield dividend stocks today.
Yeah.
Think of it like this: getting paid just for holding on to a piece of a company.
And it's more relevant now than ever.
Right.
Our sources show that a lot of investors are feeling a bit skittish about the market's direction. Over 60% actually think things might head downhill in the next 6 months. Inflation, potential recession, geopolitical risks, all playing a part.
Yeah, I can see why folks are nervous.
Yeah.
So where do these dividend stocks come in?
Well, historically, high-quality dividend stocks have done a pretty good job of weathering market storms. They offer a steady stream of income even when prices are fluctuating.
Okay.
But here's the catch. You've got to focus on companies with strong business models and consistent cash flow. Those are the real money makers in the long run.
So it's not just about chasing the highest yield, it's about finding those reliable companies that can keep those dividends flowing, right?
Absolutely. It's like finding a geyser instead of a puddle. You want that consistent flow of income.
Right.
Our source actually highlights 3 companies that fit the bill: Canadian Natural Resources, CNQ,
Okay.
Enterprise Products Partners, EPD, and NNN REIT, also known as NNN.
Got it.
Let's start with CNQ.
Okay, C&Q. I'm intrigued. I mean, they're Canada's largest oil and second largest natural gas producer, right? That's got to count for something.
It does, but their size isn't the whole story. What's really impressive is their massive reserve base, over 5 billion barrels of oil equivalent.
Wow.
It's like having a huge safety net ensuring production for years to come.
Okay, that's a lot of oil. But doesn't the energy market have those crazy price swings? How does that affect a company like C&Q?
That's where things get interesting. CNQ has a remarkably low break-in cost, somewhere in the low $30 per barrel. This means they can still generate positive cash flow, even if oil prices take a dip.
So they're basically profitable even when times are tough. That's pretty reassuring. But what are they actually doing with all that cash, stockpiling it like Scrooge McDuck?
Actually, they've been sharing the wealth with investors for 25 years straight, consistently increasing their dividends. They recently bumped it up another 4.4%, bringing the yield to a tasty 5.8%.
Wait, hold on. A nearly 6% yield, and they're buying back shares and paying down debt. What's the catch?
Well, no investment is without risk. But what's fascinating here is that CNQ seems to be undervalued right now.
Okay.
Their implied free cash flow yield is over 12% at a $75 WTI oil price that suggests there's room for the stock to climb.
Okay, so C&Q has a solid track record, consistent cash flow, and a great dividend. But I'm also curious about EPD. They're in the energy game too, but in a different way, right?
Right. EPD is a midstream powerhouse,
Okay.
meaning they operate over 50,000 miles of pipelines and a vast network of storage facilities. Think of them as the essential infrastructure that keeps energy flowing throughout the country.
So instead of drilling for oil like C&Q, they're making money by transporting and storing it regardless of the price fluctuations. That sounds like a pretty stable business model.
Exactly. EPD relies on long-term fee-based contracts.
Okay.
It's like renting out real estate. You get paid whether the price of the property goes up or down.
Yeah.
This makes their cash flow much more predictable compared to traditional oil producers.
Okay. I like the sound of that. Less roller coaster, more lazy river.
Yeah.
But what makes EPD stand out from all the other pipeline companies out there?
Well, their financial health is impeccable.
Okay.
They boast a low leverage ratio of 3.1 times EBITDA, a sign of responsible debt management, and have an A-range credit rating. Plus, their distribution yield currently sits at a very healthy 6.5% with 26 years of consecutive increases.
Wow, 26 years. They clearly believe in sharing the profits, but are they just sitting back, collecting fees and calling it a day?
Not at all. EPD is actively expanding, constructing new gas processing plants and pipelines to capture future growth opportunities. They're not just riding the wave, they're building their own.
Smart move. So EPD offers stability, a juicy dividend, and a forward-thinking growth strategy.
Yeah.
I'm starting to see why our source picked them, but how does their current valuation stack up against their past performance?
That's a key question right now. EPD is trading at a lower multiple than its historical average, around 8.7 times operating cash flow compared to a 10.3 times average. And analysts are projecting solid cash flow growth in the coming years, which could lead to a potential 10-13% total return per year.
Okay, now we're talking solid returns with a lower risk profile. EPD is definitely making a strong case for itself, but we've got one more company to cover, NNN REITs, the real estate player,
What's this?
their story.
Yeah.
And then REITs, they're all about real estate, right?
Yeah.
Not exactly the first thing that comes to mind when I think of high-yield dividend stocks.
Right. It's a different flavor, but NNN has a unique approach that makes them really interesting. They specialize in Single-tenant retail properties, things like convenience stores, car washes, restaurants, the kind of businesses you see everywhere.
So even if the economy hits a rough patch, people still need their coffee and their cars washed right. Makes sense.
Exactly. NNN focuses on those essential businesses that are more resilient to economic downturns. And get this, their occupancy rate is a staggering 98.5%. That means almost all their properties are generating income.
Wow, that's impressive. But what about the risk of tenants moving out?
Hmm.
I mean, businesses come and go, especially in uncertain times.
That's a fair point. But NNN has a couple of tricks up their sleeve. First, they snag those top-tier tenants with strong credit ratings, the kind that are less likely to skip town. And second, they lock them in with long lease terms averaging almost 10 years. That provides a pretty stable and predictable income stream.
Okay, so they've got solid tenants and long leases, but are they keeping up with the times? The retail landscape is constantly changing, especially with online shopping and all that.
They're definitely not stuck in the past.
Oh.
NNN strategically chooses properties in growing markets with favorable demographics. Plus, they're actively acquiring new properties that fit their criteria, recently adding 31 new locations to their portfolio.
So they're not just sitting on their existing properties, they're actively looking for opportunities to grow. That's encouraging, and of course I have to ask about the dividends.
Of course, NNN boasts an impressive 35-year streak of consecutive dividend increases, and currently they're offering a 5.5% yield, which is nothing to sneeze at.
Definitely not. So NNN focuses on essential retail, has a rock-solid occupancy rate, and a long history of rewarding investors with dividends. But how does the market value them compared to other REITs?
Well, NNN is currently trading below its historical average, which suggests there might be some untapped percent. Potential analysts are projecting a steady growth rate in the coming years, with total annual returns potentially reaching a 10%.
All right, so we've got three companies, each with their own strength and ways of generating income. C&Q, the oil and gas giant riding the energy wave. EPD, the pipeline king with its steady fee-based model. And NNN, the essential retail real estate play. But let's be realistic here. No investment is foolproof, right?
Yeah.
What are some of the potential risks we need to consider with each of these companies?
You're absolutely right. Risk is always part of the equation. Let's break down those potential challenges, starting with C&Q. Their fate is closely tied to the price of oil. While their low breaking cost gives them some breathing room, a prolonged drop in oil prices would definitely impact their profitability and potentially their dividend growth.
So even with those massive reserves and efficient operations, they're not completely immune to the energy market's volatility. What about EPD? They seem pretty insulated with those long-term contracts, but surely there are some risks there too.
You're right, those contracts provide stability, but EPD does face regulatory risks. Changes in environmental policies or pipeline regulations could impact their operations and potentially force them to make costly upgrades or adjustments.
I can see that pipelines are often at the center of political debates and environmental concerns. And what about the long-term demand for oil and gas? The world is moving towards renewable energy, isn't it? Could that affect EPD's business down the line?
That's a great question, and it's something investors need to consider. While the transition to renewable energy will take time, a significant decline in oil and gas demand could eventually impact the volume flowing through EPD's pipelines.
So EPD is a solid play for now, but investors need to keep an eye on the energy transition and how that might affect their long-term prospects. Okay, last but not least, what about NNN? Those essential businesses seem pretty stable, but are there any potential pitfalls there? NNN seems like they've got a pretty good thing going, focusing on those essential businesses, but are there any cracks in that armor?
Well, even essential businesses can feel the pinch if consumer spending takes a nosedive.
Right.
If the economy weakens, people might cut back on, dining out or car washes or even those late-night convenience store runs.
So even NNN isn't completely immune to economic cycles.
Yeah.
Those long leases help, but a prolonged downturn could still make things a bit shaky, right?
Exactly. If tenants start struggling, it could eventually impact NNN's occupancy rates and rental income. Something to keep in mind.
Okay, so we've explored these three dividend-paying companies, C&Q, EPD, and NNN. Each one has its own strengths and risks, but they all seem to offer a way to generate income in a market that feels like it's on a seesaw. But how do these options stack up against other income-generating investments? What about bonds, for example?
That's a smart question. Bonds are often considered a safer bet than stocks, especially when things get volatile. But the trade-off is that they typically offer lower yields. But think of it like this. Bonds are like a slow and steady tortoise, while dividend stocks can be more like a hare Potentially faster growth, but maybe a bumpier ride.
So bonds are the reliable, but maybe less exciting option. What about REITs? We've already looked at NNN, but are other REITs worth considering for income?
REITs can definitely be appealing for income-focused investors, but they tend to be more closely tied to the real estate market's ups and downs. So if property values take a hit, your REIT investments could feel it too.
Right.
It's important to diversify within the REIT sector, just like with any other investment.
Diversification, that's the key takeaway here, right? Don't put all your eggs in one basket, whether it's dividend stocks, bonds, or REITs.
Absolutely. Building a well-rounded portfolio means spreading your investments across different asset classes, each with its own risk and return profile. Think of it like building a strong foundation for a house. You need a mix of materials to create stability and resilience.
So where do these dividend stocks fit into that foundation? Are they a good option for someone looking for steady income, or are they too risky in this unpredictable market?
Well, it all depends on your individual circumstances, your risk tolerance, and your investment goals. Dividend stocks can be a valuable tool, especially those with a history of consistent payouts and strong financials, like the ones we've discussed today. But it's crucial to do your due diligence, understand the potential downsides, and make sure they align with your overall investment strategy.
So it's not a one-size-fits-all answer. There's no magic formula, but there are definitely options out there for those seeking reliable income streams.
Exactly. And remember, investing is a marathon, not a sprint. It's about making informed decisions, staying patient, and focusing on the long game.
Well said. We've covered a lot of ground today, exploring the world of high-yield dividend stocks, analyzing 3 promising companies, and comparing them to other income-generating options. Hopefully, you're feeling a little more confident about navigating the market and finding those investments that fit your needs.
Remember, knowledge is power. The more you learn about different investment strategies, the better equipped you'll be to make those smart decisions and build a portfolio that supports your financial goals.
That's right. Keep learning, keep exploring, and keep that income flowing. Until next time, happy investing.